In New York with today's Smart Money Opportunity is Art Steinmetz, portfolio manager of the 5-star rated Oppenheimer International Bond Fund. Arthur, good to see you again. Welcome back.
Nice to see you, Bill. Thanks.
Make the case for these bonds. They do yield more than we get in this country, but that would suggest more risk, though, wouldn't it?
Certainly does. To answer that question, you have to go back in history a little bit to 1981. You may recall back in the 70s, the United States had something of an inflation problem. In 1981, the yield on long-term treasuries was about 14%. Sounds emerging market-like, doesn't it?
I remember it well.
And you know, the Fed shifted their management a little bit and started stepping on inflation really hard with good, solid, tight monetary policy. Now, the bond market vigilantes were pretty skeptical at the time and kept hitting bond prices whenever there was any whiff of inflation returning. For many years, that kept real yields in the United States very high. The spread of bond yields above inflation was very, very generous. But bond yields did ultimately come down, and you had that rarest of times when bonds were a good growth investment. You got good capital gains on bonds. And that's because there was that backward-looking risk premium embedded in U.S. Treasury bond prices and yields.
If I'm a U.S. investor investing in some of these emerging market bonds, what about the currency fluctuations that can occur and erode gains that I might have otherwise?
Sure, it absolutely could happen. But if you look at Brazil today, or over the last few years, it looks a lot like the United States in the early 80s. Now, that currency risk is something which creates an additional risk. But consider what's going on now. This is a country which now has a primary surplus on their fiscal budget, and they're running large and growing current account surpluses. They're not a trade deficit country like the United States is. Not only that, the central bank is accumulating reserves at a furious pace. They have over 120 billion in reserves right now and growing. So from my way of thinking, they've got a lot of sandbags around that country that weren't there just a few years ago.
So you like Brazil. Who else do you like right now?
Well, generally that theme we think is an important one. Brazil is the most dramatic example of that. But we're probably in the 7th inning there, because again, this has been going on for several years now.
Okay.
But with inflation below 5% and yields above 11%, or around 11%, we still think Brazil is pretty fancy. But the story is being played out to a lesser extent in many Latin countries, Mexico, Colombia. Again, not to as great a degree. Turkey's an interesting one. It's a little bit more of a sporting bet because they live in a little tougher zip code. But another situation where inflation management has not been the best, if you look at history, but we think going forward it's getting better all the time.
You also like Russia right now.
Russia's a different story because that's really a stability story. While you can't say it's a real liberal democracy, and minority shareholder rights certainly aren't respected so much, so I would not be happy to be an equity investor. But local yields there are still, 6 to 8%, which is pretty decent, and there's a currency which is certainly at very little risk of devaluing because of the huge oil revenues they have. And
in fact, we saw that currency playing a role in some of the art auctions that have been taking place here in New York.
Certainly.
Interestingly enough, the ruble. Hey, Art, good to see you again. Thank you.
Thanks for having us.
Art Steinmetz there in New York.